We bought a big portfolio, a $500 million portfolio from Blackstone. And I was like, all right, man, we made it. This is going to be $1 billion fund. And about 30 days later, COVID hits.
What does a typical business plan look like for you guys under your fund?
Yeah, we're value-add investors. Most of our holds are, call it 3 to 5 year holds. What really stands out is our capital improvements.
Can you share a story about a deal that things didn't go as planned?
Some of our assets along the US-Mexican border have stalled a little bit.
Did you first raise the money and then you start saying, okay, let's build out a team, the acquisition side, and then start pursuing assets?
We spent almost 2 years just proving out the thesis, underwriting deals, even putting in offers, just to get in that deal flow, get our name out there before we started taking a position.
Welcome to another episode of the Dealmakers Chronicles. Today we're joined by Brett Turner, Senior Managing Director of Acquisitions and Dispositions at BKM Capital Partners. Welcome to the show, Brett.
Hey guys, nice to be here.
Thank you for joining us. I know it's not always easy during the day, but thank you for allotting the time for us.
You got it.
Yeah. So we have a lot of conversations with industry professionals, and a lot of them start in their 20s, some start in their 30s. I think this is the very first time I'm meeting somebody who started their career in the teens. Do you want to take us back to how that came about, how you got into real estate as a teenager?
Yeah, absolutely. So late teens. So I was 18, 19 years old when I started, but it really started just trying to get into real estate. And I remember thinking back about what I wanted to do at a pretty early age. And real estate was just kind of always the thing, right? My great-grandfather owned hotels. My grandfather owned apartments. My dad was a senior partner at a real estate law firm. And so I always knew real estate was going to be my jam, right? And I never really stopped to ask myself, who I wanted to help in this world. And that's probably something I should have done. But yeah, I love doing what I'm doing, and absolutely no regrets. I came out of high school as a soccer player and was not going to play in college, and I was looking for something to do. And I did a triathlon. I did really well. I went pro pretty quick, and so the first couple of years of college, I was a triathlete. That's kind of how pay a little bit of money to find some beer and things like that on the weekends. But really what that was calling around looking for sponsorships, right? And this is at a time before social media, before anybody sort of did sponsorships the way they do now. You would just call up a company and say, hey, yeah, I'm so-and-so, can I have some money? And I got pretty good at that. And so I had 14, 15 sponsors, something along those lines. But it really wasn't paying the bills, and everybody else was having a whole lot more fun than I was. I was working out for 8 hours a day. Everybody else was going to frat parties, things along those lines. And again, I knew I was going to go into real estate, so I got a hold of the Building Industry Association handbook. There's 300 people in this book, and one summer between my sophomore and junior year, I called all 300 of them and asked for a job. So it's the same thing, right? Not being afraid of the phone, asking people for something. And the one person that said yes was this land brokerage. It's called the Hoffman Company. And at the time, this is call it like 2003, 2004, something along those lines. Home building was just taking off. Everybody wanted to be a home builder. This is when everybody's mom was a real estate agent and all the things, right? And my job was to go into a place called the Antelope Valley, which is kind of the high desert of LA, and assemble these parcels in order to get about 40 acres so you could build a subdivision on it, right? That was the job. So in my dorm room, I had one desk that had my books on it, right? My computer and things like that. And the other desk across from it had a fax machine and BlackBerry, which tells you kind of how old I am and why I have this gray hair. But, I was like the steel maker, right? And I'd be, working over here, and, putting these deals together and slicing and dicing. And the idea was that, especially back then, the Antelope Valley, which is Palmdale, Lancaster, and Rosamond, again, high desert of LA, had been chopped into these 1 acre parcels. And so I had to call around and do these assemblages that nobody else wanted to do. Absolutely nobody. There was, buying an acre is like a $25,000 transaction, which was a lot of commission to me, but not a lot of commission to anybody else. But it worked out pretty well. We did a assemblage called Beryl Springs. I think that was like 87 parcels. Another one called Quartz Hill in Lancaster. That was like 40 something. And again, not being afraid of the phone, calling up and asking somebody for something, developing those salesmanship skills at an early age has served me really, really well. But at the time, I thought, like, hey, this is great. This is awesome. Is this too good to be true? I'm going to drop out of college and do this full time. And I had a professor that talked me out of that. And that's a pretty good idea. Because by the time I got out of school in 2006, home building was decimated. Like, I mean, there was nobody left. Everybody thinks the recession started in 2008. Well, for home building, it was really 2006. And so something that I think is really important is you can't be married to your thesis. I really wanted to do this land play thing for the rest of my career, but I knew pretty quick that that wasn't going to pan out for me for the near term. And I sort of need some near-term success. So I jumped over to HFF. That was a great training ground. Now, as a mortgage broker, they had a fantastic way to teach you Argus, teach you the financial analysis, look at a bunch of different properties, look at different types of properties. I was doing hotels and multifamily and industrial and all these things. And it sort of gave me an institutional button. And I think that's really important on young people's resumes, is to be institutionally trained. It would have been great being a land broker for the rest of my life, but it's kind of surface level and it's kind of dialing for dollars. And even though those skills are really, really valuable, you need the analytical skills that an institution will teach you. So from there, I worked on that for about a year. Come home one day, my girlfriend at the time, my wife now, she's in tears. She's like, my company was bought out by L'Oreal. I'm like, hey, wouldn't it be cool to go to New York? Wouldn't that be? Turns out she's the only person to get transferred. And so she comes home one day, she's like, we're going to New York. I'm like, oh, crap, I better get a job. And so went out, interviewed with a bunch of places, got a job with Barclays Capital, and that was a great experience. Like, you guys are in New York, but for everybody who's not, you sort of look at New York and go, oh my God, these guys they work so hard. They got the three-piece suits on, the cufflinks. Oh my, you get intimidated until you actually go there and realize they're just people too, and they work just as hard as you do, and they're no smarter than anybody else. They just have this ambition, and you live in a city, and it's just palpable. Like, I mean, you feel the ambition just driving around in a taxi. I mean, it's crazy, and so that was a great place to be as like a 22, 23-year-old guy, just trying to figure out the inner workings of a bank, how to work on a trading floor, how to do all these things. And again, it kind of gave me that button that when people look at my resume, they say, hey, this guy's an institutional guy, right? And so I think that's a very, very important lesson early in your career. Now, 2008. Sorry, go ahead.
No, go ahead. I was just curious too. So when you're as a teenager, call it a kid, you almost know where you're going. Maybe not so much with the career because you call 300 different companies. But do you have in mind a certain person in the future that you'll become, and you're striving to get to him, or how are you so ambitious at that age? And you like, a lot of people scramble. They don't know what they want to do. You just found what you want to do. You got a job. You went for it, and you just took off. Like, what was behind that?
I think it was almost the easy way out, right? I mean, again, my dad, my grandfather, my great-grandfather, all in real estate. So when I said, hey, I want to be in real estate, everybody kind of gives you the approving nod and things along those lines. And so it was a straight path for me. The harder thing, and probably something that I should have done, was say, hey, what do I actually want to do? Now, I will say this, in any industry, medical sales, whatever, your personality is going to take you to the part of that industry that suits you best. For me, it's acquisitions. I was never meant to be a banker. I tried that. I tried the land brokerage thing. I mean, that's just not for me. But it is for some people, and that could have been the same thing in anywhere, healthcare, whatever. I mean, so I do think that you can find sort of your calling, in the industry itself, and you just kind of got to get your foot in the door and kind of figure out where you're going to go.
How were you able to develop that sales personality, being able to call anybody at any time and not being worried about rejection, right? Because you started this early as a teenager. Usually sales is something that you build up and you learn throughout the years. But the first time you get on the phone, you're scared, right? You're scared of rejection. You're scared of those voices on the other line and not being able to know what you're saying.
So I think I was naive, right? I mean, I didn't realize, and it was also like a pretty low stakes environment. Somebody didn't want to give me a sponsorship for triathlons. That's okay. Like, I move on to the next one. I don't have a boss breathing down my neck or, bills that have to get paid. I mean, I was sort of like, hey, it's kind of something I'm doing for fun. And I think that's really important is, just trying to, have fun with it, take the pressure off. And I realized that that's pretty hard to do if you're a new college grad working for, Marcus and Millichap or, whoever, where they kind of, give you a handbook and say, okay, go call. That can be pretty intimidating. But again, try to develop those skills in a low stake environment. And you can do that by like raising money for charity or, something along those lines that, doesn't mean that you can't pay your rent that month.
Correct. Okay. So take us through, once you were in Barclays, what was about Barclays that, you said you enjoyed that part, learning being on the trading floor. I started my career on the trading floor in JP Morgan. So how'd you end up to make that switch back to real estate?
Yeah. So, so I was still working as a banker. I was doing conduit lending. I was the CMBS guy that, everybody blames for the recession. So 2008 rolls around and my group blows up, right? Just like everybody else. And I was devastated. I thought it was something I did, things along those lines. It's not. Look, if you're pushing your career like you should push it, you should get fired a couple of times, right? And so don't mean that as like, to be facetious, but like, it's not the end of the world. And so again, dialed for dollars, right? I was just looking the news, who was active. Turns out this little family office called Bixby Land Company was doing some deals. And so called up, and the day that I called, the guy that I replaced decided to go be a professional poker player in Las Vegas. And so when I said, hey, do you have any jobs? Like, well, yeah, actually we do. And this is the time when Texas Hold'em was really big. I don't know if you remember the James Bond movie, Quantum of Solace. And I mean, this was super popular, right? Everybody thought that they were going to be the next Rounders and, Matt Damon. But, so I'll take that job. Yeah, absolutely. And that was a great place to be, and I really thought at the time, hey, should I go back and get my MBA? Should I, get $100,000 in debt? And, this will be like a 1-2 year thing. And then the job market will be great again. Deciding to work during that time was a phenomenal decision. Bixby Land Company was going through a management turnover where they had sort of kicked out the old guard, the new guard came in, and they were selling off all these odds and ends that the family had accumulated over, it's actually a 150-year-old family, and put it into institutional quality real estate. So while nobody was doing anything, I was super, super active. And so I did about 40 transactions, both buying and selling, and it was all about cap rate arbitrage, right? Sell a 5 cap, buy a 6 cap. Sell a 7 cap. Oh, sorry, my light just went out. Sell 7 cap, buy an 8 cap. Things along those lines. And it was a great place to be because 2 years later, all those people that had decided to go and get their MBA was starting to ask me for jobs, right? And the only difference was they didn't have 2 years of experience and they had $100,000 of debt. And so it was a really, really good decision. But over that time, we sort of ran through all the assets. Everything had been transferred over, and decided to go to really try to build something. And that's something that I would encourage a lot of people to do. Sometime in your late 20s, you hit this sweet spot where you have the most to gain and the least to lose. You don't have car payments, mortgage, kids, wife, all the things that people depend on you for. But you also have a little bit of experience, and it's time to take a big chance. Now, for me at the time, I said, hey, I moved to New York. That was a big chance. Maybe kind of didn't work out, but let me go take another shot. And so I jumped over to a company called Voight Real Estate Services. Mostly it's known as a brokerage company, but for me, what I was there to do is sort of build up the next CBREI, the investment house within a brokerage community. And it turned out that the guy who interviewed me was named Brian Malliot. And I really believed in Brian. Brian had this vision and this drive that I was just really, really attracted to. I really wanted to be a part of that. But the owner of the company, Bob Voight, was in his, I think, early 70s at the time, and just didn't really have the drive. And so spent about a year there, bought 6 seed assets, raised some money, took it to Bob Voight and said, yeah, hey, I just want to go sit on my boat. I don't really want to do this. I'm like, well, Bob, I wish you would have told me that a year ago. And so I'm in the parking lot, just feeling sorry for myself. And I see Brian walking out the door with a box, right? And he had just quit. And in that moment, I made a split-second decision that changed my life forever. I went up to him and I said, hey, man, I don't know where you're going, but take me with you. And I really didn't know where he was going. But, you talk about, sort of all this preparation and this mindset and things like that. It really comes down to little moments in your life that put you on a vastly different track that you would ever otherwise be on. And it was such a cool experience. Where Brian went was Fiji and Hawaii and Salt Lake, and it didn't take me to any of those places. But about 6 months later, he got his ass back in gear and said, "Hey, Brett, let's go start a new company, and let's call it BKM Capital Partners." And I said, "Sure, all right." And show up day one, and he's like, "What do we do?" I'm like, "I don't know, go buy a computer." And so I went down to Best Buy and bought a computer, and you really started taking off. And that was the start of it. This is 2013, I want to say, 2012, 2013, something like that. Yeah, and we just started in a coffee shop. It was a coffee shop called Zinc Cafe, and putting together these pro formas and trying to think through what the vision of the company was. And I think we both aligned that we wanted this thing to be really big. We didn't really know how it was going to get there, but from the very, very start of it, we built it for scale. And I think that's a big difference between us and a lot of other companies. And I'll go into that in a little bit more detail. But from a very, very early stage, we started saying like, hey, how do we put process and procedures into place that seem cumbersome and ridiculous right now, but where we're going, we're going to really, really need that. And that turned out to be a pretty good decision.
Oh, okay. So you started, I mean, you've done all aspects of real estate: acquisitions, asset management, finance, even environmental remediation. Which one of those experiences would you say was the most beneficial to you being a deal maker? Was it the financial aspect of understanding how to underwrite a deal from the finance side? Like, what would you pinpoint to this specific title gave me the most experience I needed to become who I am now?
Yeah, so that's a great question. I mean, and just to be really clear, I don't want to be a property manager. I don't want to be an accountant. Yeah, God bless the people that do, but that's not my jam. I did it because we had nobody else to do it, right? Yeah, and so thinking about like how to learn about real estate, it's really a hands-on. It's a real asset, right? You really got to get in there and do it yourself. And that was a really big learning stage for me, is to put all these things together. You buy your first asset, and then they're like, "What kind of accounting software do you want to use?" I'm like, "I don't know. I never thought about accounting software. What do other people use? Let me go look at MRI and Yardi and all these things. What kind of property management software do you want to use?" I mean, all that kind of stuff, right? You really start getting into these things that you sort of just take for granted. When you're in acquisitions, you're not underwriting the asset or the market. You're underwriting your company. What can your company do, right? It's not what market rents the market's going to give you. It's what is your leasing manager going to be able to pull off, And so knowing the company from the ground up, is absolutely beneficial. And understanding the process and procedures that we put into place day one, 12, 13 years ago, something along those lines. You sort of have all this tribal knowledge that helps you underwrite, to very, very fine, very detailed way. So, to answer that question, certainly the asset management, certainly the property management, certainly being able to interact with tenants, being able to lease a space, all of those things, having experience makes you a well-rounded person. Not a lot of people come into acquisitions from out of college, right, with no previous experience. Usually come in from some other different angle. I happen to come in from the finance side, but really, in all different ways, just by learning from that ground up position.
So you executed at this point, correct me if I'm wrong, close to 5 billion or over 5 billion transactions?
Yeah, I think I'm closer to 6 or 7 right now.
Wow. Okay.
Yeah.
So close to 6 or 7 at that point. So how do you go from that coffee shop where it's just the two of you, and you're just bought a computer from from Best Buy, to $6 or $7 billion in acquisitions, right? Because you needed processes, or walk us through those initial steps that got you to a point where now you're talking about acquiring millions of dollars of real estate.
Yeah. So, I mean, I think something that a lot of people do is, you just started this company, you put a bunch of money into it. How do you make revenue as fast as possible? That really wasn't our goal. Our goal was to create a fund management business. And there was 1,000 joint ventures or separate accounts that we could have taken on, but we didn't want that. We wanted a diversified fund management business. And we stuck to our guns. Yeah, and our fund one was small. It was $130 million. We took some gap capital from CalPERS between fund one and fund two. That sort of gave us that institutional button. Companies are just like people in a lot of ways. And then fund two was about I want to say 380, 100 million, something like that. And so it was a big jump. And with each one of those, you get a little bit more institutional, you get a little bit more sophisticated, you start learning how to manage teams, things along those lines, and you really just start clipping these off. But our last deal that we did in Fund 2 was January 30th of 2020. And we bought this big portfolio, at least big for us. It was a $500 million portfolio from Blackstone. And I was like, all right, man, we made it. We're going to Fund 3. This is going to be $1 billion fund. And about, 30 days later, COVID hits. And I'm just devastated. Look, market's falling through the floor. I'm like, I'm the last guy at the dance. I just bought this thing. I'm going to be the laughing stock of the industry. And it turned out it was a great buy. We made a killing on that purchase. But the one thing that it did do was make Fund 3 basically impossible to go raise at the time, right? Nobody could get on planes, nobody could meet in offices. Just the way of raising money previously just wasn't going to work. We also took the time to buy out our financial partner. That got a little messy, took a lot of resources from the company. And they're like, hey, let's go do a joint venture or two. And that joint venture business really started to take off. And one of the things that we focused on was offshore capital. And so a lot of capital out of Latin America, a lot of capital out of the Middle East, a lot of capital out of Europe. And that was a pretty good decision because right after COVID, once we really started getting the JV business going, interest rates started to spike. A lot of the domestics started to pull back. We leaned into that. And a lot of that came from geopolitical turmoil, things along those lines, where people wanted a safe haven for the money, and that was in the US. And so we could put their money to work in a great asset class. It was an industrial, it had a greater cash yield, things along those lines. There was a margin of safety. We had a proven track record now that we had, Fund 1, Fund 2. And that was a pretty good deal. So by 2024, I want to say, our revenue from the joint venture business was the same as our fund business, and so both of them equally came as important. But more importantly, during a time where people were pulling back, we leaned in, made some terrific buys, and maintained our activity. So to answer your question, a little bit more directly, how do you pull off $6-7 billion in acquisitions? It's by being active throughout the cycles.
And did you know that raising a fund was the best option for you from the beginning? Because a lot of sponsors we have conversations with who do have a fund, they all started with syndicating deals. They build a syndicate track record. It seems like you guys went to a fund structure immediately, right?
Yeah, we did. It was hard. Only 4% of first-time funds actually get funded. And it was, it was really, really tough. I remember, I'm not sure where you're located, but being in FIDI in Goldman Sachs office, and the guy scratching his head, he's like, what is this small bay thing? You mean they're like people making t-shirts in their mom's garage, need like a little extra space in that, like self-storage? I'm like, no, it's totally different. Just you gotta trust me. And, they did not get it. It was 2016, and Blackstone came out with an article that said, hey, this small bay asset class is actually, it might have some legs to it. And that really helped us, start raising some of that capital. But it was a tough go, man. It took more time, more effort, more money. It was a slog.
So
we ended up,
this whole time, you guys are raising funds. Are you doing it through a placement agent that's setting up these meetings? You are.
Yeah, we did. So our first one, MCA came in, Mercury Capital Advisors, helped us with that. They've subsequently been bought out by InvestCorp. But that really, really helped. Yeah, and they really brought in two large institutional partners that anchored that fund. And but more than that, I think we did 87 meetings. Boston, Philadelphia, DC, New York. You're just traveling all around. it really helped us to find that pitch, right? And to get our marketing materials together. Hey, what didn't work? How do we do better next time? And just get the reps involved. I'm sure, that's not what they're looking for. They're actually looking for money, but, from our standpoint, it was a great, great training ground for us.
One thing you mentioned before is making great buys. And one thing that we've noticed when we speak to great sponsors, it's never just reading the Excel spreadsheet. So it's a combination of what the numbers show and the gut that they pair that with in their experience. How do you make decisions in terms of what you execute when you're looking at a property?
Yeah, so we have this software called BKM Intel that gives us a tremendous amount of data. We have about 3,000 tenants in our own portfolio. We have about 1 million square feet plus in every single market that we're buying in. And so we have a lot of data coming to us, and we have a great way to synthesize that data through an AI BI software that you can really dial in what the rents are, what the TIs are, all the things, right? But data is only as good as the input. There's a qualitative sense to any kind of lease comp or sale comp that you really have to know. At this stage, we've seen most of the assets trade in our universe. And so we've underwritten them previously. We know who the owners are. We know who their leasing brokers are, things along those lines. And if they did a lease and it was a $20 TI, but they had to rip out a bunch of office and they had to, move some loading doors and things like that, there's a qualitative, and there's a story behind that you have to know to make good assumptions. And then I think, a lot of it too is, what's the story behind the seller? You tell me who the seller is, I can tell you if we're going to buy the property or not. At this stage, we know who's good in the space. We know who still has some work to do. And we know, really, who we've been able to transact with and be profitable from in the past.
So there's a lot of directions you can go with when it comes to investing. It seems like you guys picked the small bay light industrial. Can you give us a little insight on why that specific niche of an asset class? Like what stood out? And when did you start considering it for the first time? And in preparation for your fund, were you saying with your partner, okay, we need something different that we can pitch to investors? Was that the reasoning behind it? Or was it always, oh, this is a great asset class, let's raise a fund for it?
Yeah, look, it's better to be lucky than smart. In 2012, this space was almost entirely mom and pop investors. We thought that we could institutionalize it the way that Reef had, the way that the coal companies, KOLL company had in the past. They'd kind of sold out, gotten out of the space, but we still thought that there was a lot of money to be made. And what we saw was a premium between sort of the core big box and the small bay industrial. And if we could institutionalize it, where we'd have scale, have pricing power in the market, be able to buy at bulk, things along those lines, we could outperform sort of that mom and pop investor. And then we also saw that these guys are really, really resilient. There's this notion that if a 5,000 square foot tenant is, as soon as they get a hiccup in the economy, they're going to go right back to working out of their house. It's not like that at all. This is a 47% of America that works for small business. And if you're an institutional investor, working in New York, your mind thinks that any small business is anybody with less than 500 employees. That's not what small business is. Usually these small businesses have 3 to 10 employees, and they've been in business through multiple generations. It was their grandfather's business that got handed down to their dad, that got handed down to them. And it's the heart and soul of their family, right? I mean, these guys are literally taking money out of the till to buy groceries. This is the last line of defense. And so we were able to pull some data in from PS Business Parks, and then we also saw it through COVID, and we saw it through the interest rate hikes, where these guys are amazingly resilient. I mean, amazingly resilient. If you have good hands-on management, you have your tenants paying rent through the cycles, changing business strategies on a dime. I mean, this isn't 1 out of 15 locations where one goes bad and you just shut it down, no problem, you've got 14 left. This is the only way they're paying their mortgage. So they've got to make it work. And you put a guy like that, you put his back up against the wall, he'll figure it out. And I think we've proven that.
And with your business plan, do you look at a specific asset and you say, okay, this tenant's paying me very well. I'm going to just buy it. I'm going to keep it for cash flow and then sell in 8 to 10 years. Or is there some kind of a value add component where maybe you want to build an extension or get them out, get somebody else in? What does a typical business plan look like for you guys under your fund?
Yeah, we're a value add investor. So most of our holds are, call it 3 to 5 year holds. We're looking for returns around 20 IRRs, with a good mark to market story or a lease up story or something along those lines. But I think what really stands out is our capital improvements. So we come in with a great paint scheme. It's definitely a BKM brand. You go on our website, you're going to start identifying BKM assets, in every single market that we're in. Landscaping, it's modern, drought tolerant landscaping. The signage is a huge deal. People don't realize this, but if you own your own business, you got a huge amount of your ego wrapped up in it. You want a big, nice sign right above, your door front, and that makes a difference. It also makes a business park look like, there's a bunch of people in it. You go to these parks and nobody's got signs, it's like, the party's empty. Nobody wants to go there, right? And so, having this kind of stuff, really, really starts to make a difference. And so we're able to take rents, and there's nice mark to market, just kind of day one, but there's an additional mark to market that we can go get with our capital. And we spend a lot of money on our properties, but so far it's really, really paid off.
And one thing I find interesting, right? And I'm just curious how you guys went about this. Oftentimes people have an array of deals they want to look at, then they raise a fund, then they start to reach out to people whose properties they know they can buy, or they have at least an idea that they can be buying these properties, a high probability. Where there's also funds that first get the money and then they say, okay, let's start the outreach from zero. Did you guys have an idea of which assets you're going to pursue after you raise the money, or did you first raise the money and then you start saying, okay, let's build out a team, the acquisition side, and then start pursuing assets?
Yeah. So again, nobody had ever heard of this product type, at the institutional level before we really started, going around. So we spent almost 2 years just proving out the thesis, underwriting deals, even putting in offers, looking for, kind of the second place, just to get in that deal flow, get our name out there, be a little bit active before we started taking a position. Yeah. And so that's certainly one. Another thing is we just paid for it, man. I mean, we did things like, put $10 million non-refundable day one, and look, you talk about getting your back up against the wall and having to perform, that'll make you perform. Yeah. And so, there was things that we could do as a small company that the big boys just couldn't do. And there was risks that we could take that we knew would pay off, that some of the more institutional companies had too many checks and balances to be able to compete with. And so, we were really successful that way.
But do you see the competition change in your space? Because when you started, there was not too many institutional players, and it was all mom and pops. But now, after you prove this thesis to be working, have you seen more competition? Have you seen margins shrink a little bit?
Yeah. So we started disposing of our fund 2 in 2024. So in January of 24, interest rates are still going. People start seeing the end in sight, but it was still a little bit uncertain. And construction had really been tampered down at that point. And we started seeing that bid list start to grow. And those institutional companies come in, doing what we did early on and just start throwing in offers. And I'm going to exaggerate here, but sort of the first 10 were the legit guys that we knew we were going to buy, and the bottom 20 were the institutions that wanted to throw in offers, be active, and so we could see who was taking trying to take a position in this space. The problem with this product type and why a lot of institutions can't quite get in is nobody builds it over 200,000 square feet. So at $200 a foot, 200,000 square feet, it's a $40 million purchase. That's not going to move the needle for Prudential or Goldman Sachs or any of these big players, and so they need to align with an operator, and so they were out there searching. Right, one of those groups was Kayne Anderson. Kayne Anderson had taken positions in medical office, in student housing, senior housing, a little bit of self-storage, but they were looking for an arm to get into the industrial space. And kind of through talking through the network, who's the best at this product type, our name kept coming up. Yeah, and so by the time we got to the sort of the end of the disposition cycle of Fund 2 in late 2024, we had gone from selling kind of like $20-30 million deals to $550 million with Kayne Anderson. And then they came in and said, hey, we are also going to give you $1.5 billion of equity to continue to go buy this product type. Now, it's awesome. We are buying like crazy. Right now, I think I have 18 assets under contract, about $500 million. And so very, very active. Now, other institutions are doing that as well. And so we're seeing more and more institutional players come into this space. But more than that, we're seeing anybody who, sort of lost their job or, is looking for, some kind of new thesis, try to get into the small bay space. And so there's a lot of new names popping up. Nobody that's really taken a large position, but there's certainly more competition now than there was in 23.
So as you're in your third fund, I believe, right? Has your minimum deal size increased over when you first started in Fund 1?
Yeah, I would say that, but I mean, we're all deal junkies, so I can't let a good deal go. We just closed on a $17 million asset. We also just closed on a $225 million asset. So, our range is pretty large. Now that said, our first deal we ever did, I'll never forget it, was $5,964,000. It was the hardest deal of my life. Everything was brand new. But, I would say that our average deal size right now is probably about 75 to 80 million.
And how are you purchasing in terms of, are you guys financing part of it? How much of it is equity versus financing?
Yeah, so everything's financed. Typically floating rate, 3-1-1, traditional bridge loans. All at the first trustee level, nothing unsecured. Our equity buckets, there's really three of them. We have our BKM Industrial Value Fund 3. We have the Kayne Anderson 1.5 billion. And then we have 10 or 12 joint venture partners that we're active with. And so this year on that side of the business, we've done family office out of Dubai, family office out of LA, and LaSalle.
Yeah. And what rates are you seeing right now on the bridge side for your debt?
So right now, a lot of that's right around 200 for balance sheet debt. We're seeing private credit really start to squeeze. I think there's a lot of money raised in the private credit space that now needs to be deployed. We're seeing rates there as low as 235 over, kind of averaging 240, 250. Yeah, this is all over SOFR.
Yeah. And typically it's 3 years. And so you don't refinance, it seems like, not all your assets, right? Some assets you sell after 3 years out of a bridge loan, or do you always refinance into firm debt?
Not a lot of refinancing. I mean, by the time that that loan comes due, the asset's pretty well baked and we can sell it and move on. A lot of what we're finding is that the lowest cost of capital still needs an operating partner. So we're recapitalizing a lot of our assets as well. About 72% of our Fund 2 was recapitalized in some way. And so we're not looking for forever holds necessarily, but we'll stay with the asset through multiple equity ownerships.
And what cap rates are you seeing on the sell side right now when you're disposing these assets?
It's somewhere between 5.25 to 5.75. Now that's a huge generalization, depends on the asset, the location, the market, things along those lines. But there's typically a mark to market. I mean, we saw a huge amount of rent growth between 21 and call it like 23, right? And so that's tapered off a little bit, and it's good that it has. I mean, it was going at 180 miles an hour. Now we're going to 90. It's still well above the speed limit, but it's just healthy for everybody. And so I would say that there's always a mark to market that you can go achieve. So more than the in-place cap rate, I'm looking at the stabilized cap rate, and I want that to be somewhere between like 7.5. For the most part. Now that can flex down to like 6.75 to an 8. Just kind of depends on the asset and its location.
Before you mentioned that looking at the seller is important to you. Not every operator looks at the seller. They look at the property, what they can do with it. What are some of the red flags that you would be able to point out on the seller and say, okay, this is not the right property for us?
Not the right property for us. I mean, there's a lot of really great operators out there. There really are. I mean, especially some of these syndicators in the local markets do a phenomenal job. And if they've taken all the value out of it, then I've got a big universe of assets that I can go buy. I can skip that one. For us, we're looking for a value add component, right? So I want to know that there's a mark to market, that there's a capital improvement plan, that there's a leasing strategy that I can improve upon, that there's some kind of lease up play that I can go do, and so something along those lines where, we can make that margin and really start to earn our keep. Trying to ride beta, I think, is a big mistake in this game. I mean, you're looking for that alpha, right? And I think our operating platform, apply that in the appropriate positions, really starts to create that alpha.
So one thing I find interesting is the more equity you guys have, the more acquisitions you have. And it does make sense from the equity standpoint, but a lot of funds run into an issue of not seeing enough good deals. It seems like your team has an abundance of good deals. So the more equity you raise is directly correlated to how many acquisitions you're doing, just because there's just a lot of them. Is that the right impression? Like, you guys are just seeing so much opportunity, you just need all the money is coming in is going towards good deals, or are you squeezing your IRR a little bit just to kind of allocate that money somewhere?
No, interestingly enough, the IRR has not changed. It's actually expanded. I mean, we're looking for deals in the 20 IRR range. Previously that was kind of like an 18 and a half. And so the threshold is higher. Now, I will say, we are moving east. It's like manifest destiny, but in reverse, right? We're now taking positions in Texas, both Houston and Dallas. We've taken positions in Florida and Orlando. We'll get into Miami. We'll get into Chicago. We'll get into Atlanta. And then we're going to kind of pause there, make sure we build out those markets, and then before moving on. So that's certainly increased deal flow. I've hired on a Central East team to really help me with that. A guy named Charlie Farmer. He's amazing. He's a great acquisition guy. But more than anything, we're the most active player in this space. So anybody that needs to move a certain amount of product or move quickly, we're one of the very few that can accommodate.
No, so when you move into a new market, like you mentioned, you want to go into a new market. What does that entail on your side? Is it just asking one of your acquisition guys to expand their territory and reaching out to new brokers in new states and new cities, or do you hire somebody who's from that area specific, who understands the market, and kind of who has a pulse on the market, and have them bring you deals? What does the process look like when you guys want to expand a little bit?
That's a great question. So one, I will say that we underwrite a market for 2 years before taking a position there. Sometimes longer. I think Texas, we underwrote for 6 years before taking a position, where first you got to know the market, then the submarkets, and then the major streets in the submarkets, and then all the assets in the submarket, then all the owners in every submarket. And remember, our universe is smaller than most, right? I'm only looking for small and mid-bay multi-tenant industrial product. So we can do that in a fairly efficient way. It still takes 2 years, and so you really got to know these markets. But going back to something I said previously, when you're underwriting an asset, you need to know the asset, you need to know the market, but you need to know your company. Really, what you're underwriting is your company. And so having an acquisition person that's here at corporate in Newport Beach is important to me. So Charlie, bless his heart, is flying like crazy. He's gone every week, but he's still here in the office. We just got out of pipeline. We're kicking around deals. We're making counter arguments. I don't know that you get that connectivity with somebody or that person with your company by hiring a stranger in a new market. You really got to know that person, and that person's really got to know you.
So I think it is important for maybe not so much in your niche, but in the multifamily, for the acquisition guy to walk the streets, to see what's around. Does your team do that when they fly out? Do they explore the areas? Do they drive around? Like, outside of CoStar and all the market information that you look at to assess if the area is good or not, is there any boots on the ground, let's walk around kind of approach to assessing if area is good?
Yeah, and it's not just the other product, right? I mean, of course, you're looking at other competing industrial parks and things along those lines, but you're also looking at, what neighborhood's it in? I mean, is there a cool coffee shop down the street? What do the houses look like? I mean, do people take care of their yard? I mean, is there pride in this neighborhood? and then you can, complement that by taking a rundown, beat up industrial asset and making it cool and creative and, help, sort of revitalize that neighborhood along with everybody else. Revitalization of a neighborhood doesn't need to just be in multifamily and retail. It can be in industrial. You just got to know how to do it right.
Can you share a story about a deal that things didn't go as planned? Like even after all the 2 years of market research and all the data that you guys have, has there been a deal that really hit you right at the knee?
Yeah, absolutely. I mean, so one thing I'll say, we've never lost money. We've always at least broke even, made a little bit, but not IRR. All returns are created equals, right? What can I tell you? We didn't necessarily underwrite Liberation Day. And so some of our assets along the U.S.-Mexican border, have stalled a little bit. And so there's certain things like that you just can't understand. There's a great book that I've been reading, Philosophy of Money, Morgan Housel. Amazing book. Everybody should read it. One of the things that he talks about up there is the only thing that you can be certain about is that these outliers will always occur. And having a margin of safety within your underwriting protects you from that downside and puts you in a pretty good position when things do turn south to take advantage of that opportunity. And so instead of saying, oh my God, I made a mistake, pencils down, I'm never doing this again, saying like, hey, how can I continue to, press on this? How can I exploit this to my benefit? I think that's, just a great lesson that, learn from your mistakes. Don't be paralyzed by them. Learn from them, and then be willing to act on them.
Yeah, absolutely. We've seen a lot of operators who, like you said, put pencils down once they're like, okay, our thesis or our approach is incorrect, where it could be that something that is unforeseen, like in Texas, the market that you mentioned, we've seen a lot of operators get hurt because of the insurance and property taxes, right? I don't think there was a sponsor out there underwriting triple insurance premiums and 4 times property taxes in their underwriting, no matter how conservative they were.
Yeah, look, I was fortunate that I spent 20 years never thinking about insurance, and then all of a sudden I think about insurance a lot. So it's definitely a thing. And look, there's going to be new things like that happen in the future. You just got to roll with it.
So, you're doing a lot. I mean, the company is doing a lot, right? You're raising money, I'm sure, for the fund. You're looking at new markets. And there's a lot of information coming at you from, I'm sure, your finance guy, from everywhere. In terms of breaking down your day, percentage-wise, like what does it look like? What do you attribute most of your attention to? What task gets the least amount of attention?
Yeah. So my job is buying and selling. I'm the market, right? There's other people that are asset management and property management and finance and accounting and all the other parts, but I'm the market. So a lot of my day was outwardly focused. Now our team has grown, right? There's 10 or 12 people that work directly under me, and so a lot of my day is managing those folks, making sure that they have the resources to perform the best that they can, right? I mean, my job is not to, be the guy doing everything. My job is to making sure that the people in the field that need to make the decisions have everything they need to make those decisions.
You mentioned before that you were a triathlete and you look like, gym is part of your life, and to be successful at this, you need discipline. How do you, and building out a team like you built out, a company like you did, it requires discipline. What are some of the things that you do with your team to instill that discipline and that drive going forward?
Yeah, look, it's a fun team. I mean, we have blast. I think on Friday, we had a guy trying to break the world record of how many chicken McNuggets, somebody could eat in an hour. I mean, it's really cool. I mean, now I will say that, it is a very disciplined team. Everybody comes from some kind of competitive background. We're all competitive people. I think you kind of need to be in acquisitions to a certain extent. But we have a lot of fun doing it. I think we certainly have a set of criteria that we need to underwrite to. We have a lot of cross communication with the other departments, and when we celebrate big, man. Yeah, and so one thing that I will say is waking up early, getting a workout in, getting your mind right, being able to show up, kick ass. That's really important. And so I think everybody in here is, athletic to a certain extent.
When it comes to hiring and where you hire from, do you have a system where you go through a recruiter to hire people? Do you like to hire people with experience? Do you like to hire people who don't have experience, but you just want to teach them your way? What has worked for you?
Well, I'll tell you what hasn't worked for me, and that's hiring off a resume. Somebody that's got, all the brand names and all the experience and things like that has just been a disastrous decision. One of my best hiring stories is, we've got a in-house recruiter, and we also use other recruiters to find great candidates. But by the time the person gets to me, they're vetted, right? I mean, they can do the job. They can do the nuts and bolts. What I'm looking for is how do they act under pressure, right? And so one of the guys that, is no longer with the company, but he's doing fantastic up in LA, Sam Tobias. I said, hey, we can go get a coffee and we can talk, or you can come to a workout with me. And said, like, awesome, let's go do a workout. And I'm like, oh, okay. And we sat there and we did heavy squats for 2 hours as I'm peppering him with questions. That shows that this guy can, handle himself under pressure while he's stressed. And he was a great hire, man. He did a fantastic job.
That's very interesting. Is when somebody offers you that interview through the gym, I don't think 2 hours of squats is something that would have been expected.
No. And look, it's always an option. But I'll tell you this. So I get a lot of inbounds from people just graduating college and things along those lines. And as I don't do a whole lot of charity, but my way of giving back is by always meeting with those people and giving them a little bit of career advice of how to get started. And I always say, hey, we can go grab a coffee or we can go for a workout. And 100% of the time, they always go for the workout. And so not sure exactly what that means, but I think people will just enjoy the novelty of the experience.
Yeah, and I think working out with somebody is more intimate than just getting coffee. You get coffee with everybody. But working out, I guess, it's almost like playing golf with them, where you're with them for an hour and a half and you have their undivided attention. And you're bonding over an activity instead of doing something just random. But I never thought about that, interviewing somebody by working out with them. So everybody who comes across your table, I assume they're an athlete, right? So if somebody does not work out, I think the last thing they want to do is work out with you, right?
No,
Or
look, I
how do
mean,
you
we have
know?
lots of people that, don't work out. But I mean, everybody
Okay.
can, go do a bicep
And
curl.
even they agreed to
and
go work out with you, right?
Absolutely.
In an interview or no?
100%. Yeah. It's there's a lot of folks that show up to the gym that never lifted a weight before, but hey, you're right. You get an hour and a half of undivided attention, and we get to do something fun in the meantime, and it's a story. So it kind of works.
One thing that's always interesting to me is across all sponsors that we speak to, whether fund managers, syndicators, they have their own process of picking deals, right? And you mentioned you have your team now. Can you tell us what the process is? Is it committee? Is it, you have an acquisitions guy for a specific target area, that person brings you the deal and you're reviewing it and you're making that final decision? Tell us how the deals actually get done behind the scenes.
Yeah, so it's two teams. It's a West Coast team and a Central East team. Eventually, we'll probably have three and have a full-time East Coast team and move Central East to just Central. On those teams is a market officer, a associate who is underwriting the deals, putting the analytics together, and then an analyst who is doing the market research, right? The market research is a big part of the story in formulating the business plan. So it's understanding all the comps in the market, who did what deal, which brokers are good, which brokers are bad, all the things, right? And then being able to say like, hey, this 10,000 square foot space, when it comes due, the 10,000 square foot market, it's a little weak. If we chop that into 3,000 square foot spaces, that'll lease much better at a premium rate. This is why I think we should do that. And so everybody has their role. This isn't a bunch of redundancies and things along those lines. It's a very pointed, structured team where everybody has a piece to play. And so on a weekly basis, we get 10 to 15 deals in a week. And then we sit in pipeline and we kick the deals around for an hour and a half saying, hey, which ones do we want to pursue? Which ones do we not want to pursue? What's good, what's bad, and and all the things, right? What's the story behind it? Give me the qualitative side of this business. And then we decide. And so our hit ratio when we make an offer is about 50%. So it sort of tells you that when we pursue something, it's a go. And a lot of that is making sure that everybody's on board, right? And so Our investment committee is comprised of myself, our CEO, Mason Waite, and our asset management team, Bill Gallipo, and our CFO. But it's all in-house for the most part. But if I'm doing my job right, I'm walking around all those guys well ahead of investment committee, making sure that they understand the deal, what they like, what they don't like, what the opportunity is, so that we can have a more lively discussion, not about the deal itself. That's sort of already taken care of. That's signed off on. But really, what equity source, how should we structure the financing, all the things. And by the time it gets to investment committee.
Do you ever look at any deals that are not in your asset class? If a broker comes to you and says, "Hey, I sold you 4 of the small bay industrial deals. Look at this multifamily property. It's a grand slam." Is it an automatic no for you? Is it, "I'm going to entertain him a little bit, sure, I'll look at it," but you say no, or do you consider it?
Look, BKM is a one-trick pony. We do small and mid-bay multi-tenant industrial, and that's all we do. We don't do office, we don't do R&D, we don't do retail or showroom or anything like that. There's a lot of this product that can kind of go a couple of different ways, and we know what we're good at and we stick to it. You asked me previously about the times I've been burned. Typically that has been when we buy a business park and a couple of the buildings are fully office or something along those lines. That's when we've been burned in the past. That's not a mistake that I'm going to make again in the future. But I don't know how these allocators do it, where you got to be an expert in all these different product types. I mean, I just only have so much mental capacity, and I stay in my lane.
Do you at all? I know you do JVs. You invest as a GP yourself. Do you at all invest with any operators as a limited partner?
No, we're general partners. I think that is maybe an opportunity for us sometime in the future, but that's a long ways away for us.
So speaking about the future and looking ahead, right, the next 10 years, what's the growth look like for your company? Is it keep raising bigger funds and acquiring more assets? What's the ultimate goal for the company?
Yeah, so we're a value-add investor. What I'd like to do is develop a more long-term, open-ended strategy. I don't know that this product type has that yet. I think that's a really unique opportunity that we can go take advantage of. I'd like to also move into more of the mid-bay thesis. About 38% of our portfolio is mid-bay, but we don't have dedicated capital to that mid-bay thesis. We've performed phenomenally well there, so that's something we're searching for in the near term. But 5 years in the future, I want to be a true coast-to-coast company where we have solid footprint of at least 1 million square feet in every single one of the major markets.
Do you have that milestone in any particular market now?
Right now, we are really pushing to grow in Dallas, Houston, Chicago, Atlanta, Orlando, and Miami. And so we've taken positions in a lot of those, but we need to expand our footprint.
What is your overall view on Texas? With Texas was the darling baby of the COVID, right? So all the people that moved into Texas, the Austin market, the Dallas market, even the Houston market, multifamily exploded. But since then, there's been, kind of like somewhat of a carnage, at least in the multifamily space. How are those markets in the industrial space that you're in compared to what they were?
Yeah, they're doing phenomenally well. Honestly, Houston especially. People have this notion of Houston. It reminds me of Las Vegas, where a lot of people got burned in the GFC and said, "I'm never going to Vegas again." Vegas is a great market. Same with Houston. I know that multifamily in Houston and Austin and some of these places has really gotten beaten up. But from an industrial perspective, specifically in the small bay space, it's doing phenomenally. And I think a lot of that comes from the advanced manufacturing that Texas has been able to attract. You see a lot of the technology companies, Tesla, Google, Samsung. All these guys making semiconductors here, or something along those lines. That's really our bread and butter. Remember, our tenants are service sector to really the advanced manufacturing industry. So they're making some kind of widget that goes into a much bigger assembly line that these major manufacturers are putting together. And so, it's done really, really well. The assets that we've bought so far, we're blowing through pro forma like crazy. So we're big fans.
I love it. But Brett, we're in Miami. I don't know if you ever come out to Miami. I know you're looking to buy more stuff.
Yeah, absolutely.
We're between New York and Miami. If you're ever in Miami, let us know. I would love to do a workout with you.
Let's do it.
We'll skip the squats. If anything, Bulgarian squats maybe. Not the barbell squats.
Good.
But overall, Brett, it was great having you on. You're doing extremely well. I'm looking forward to seeing you guys grow and expand and start killing it in our market. And I look forward to building a relationship in person as well one day.
Hey, thank you guys. I really appreciate the time. Big fan of the podcast.
Thank you, Brett. I appreciate it.
All right, guys. Talk soon.
All right. Take care. Bye.